A lot of times people want to be on the hill saying, look, I'm the one that kind of called it right at the top. And they're looking at all these different indicators to suggest, oh, things are getting tired. Or, I mean, there's a whole host of technical indicators, sentiment indicators. Are there any that you gravitate towards to kind of tell you, not necessarily that you're at the top, but hey, it's a caution flag. It's something to be aware of, that we're in an environment that you might want to start looking at locking in some gains, or at least being ready to go on defense?
Yeah, for sure. So I think of my role. I mean, I consider myself a trend follower primarily. So my goal is threefold any given day. One is identify trends. Second is to follow those trends and assume that they will persist and make sure that I'm following the continuation of that trend. And then the third one, which is what you're alluding to, is anticipating when that trend might be over. And this is the part of the technical toolkit that I would argue is more of a leading indicator, a set of leading indicators. A lot of the technical analysis toolkit is very much a trend following approach, right? I'm looking for moving averages that are sloping upwards. I'm looking for relative strength to start improving. And all of those tend to happen after the price has already started to make progress. But there's also parts of the technical toolkit looking at divergences, looking at weakness in some metric that would tell you that even though the price is looking good, underneath the hood of the market, right, or looking at the details behind there, you start to see a disagreement. And those disagreements often have a great predictive value, because before the price tops, I mean, as the price is still going up, the conditions start to deteriorate. And it happens pretty common. And market breadth indicators are the best way I know to think about it, because especially at major market tops, when the in the later stages of that bull market phase, a lot of things actually are no longer going up. They're no longer driving higher, but the indexes keep going up because of the biggest, in a lot of ways, more defensive kind of blue chip names are strong enough to propel the index higher, even though a lot of names rotate lower. So a lot of measures of market breadth are really designed to help you recognize when that disagreement is starting to come out. And arguably, we're maybe starting to see that here in 2024.
Okay, well, let's maybe start a little bit more historically. You brought some charts. These are from stockcharts.com, with some of these indicators that you have in terms of whether it's the looking at the percentage of stocks above their 50-day moving average lines, and so on. But let's go ahead and start with our first chart, and this goes back to 2007. Of course, in 2007, as frothy as it was, no one was thinking, oh, we're probably looking at a great financial crisis next year where everything is going to grind to a halt. It's never, you never know how bad things can get. You just kind of know, oh, things are starting to turn possibly. So kind of explain, we got the price on the top here in this chart. And then you've got a few different things that you're looking at below. So can you describe those for us?
Yeah, so I'm looking at the 2007 market top really as more of a case study in what a major peak kind of looks like. And to your point, right? I mean, at that peak, which I've shaded in a purple shading area there at the top. I mean, at the top, it's really hard to recognize that that's a top, right? In the rear view mirror, it seems really obvious that okay, a lot of frothiness was happening, and as things unwind, you recognize the forces that were at work there. But at the time, the market was going up. So we basically have the S&P 500 at the top, looking at that period going into and then coming out of that 2007 peak. And then we have three indicators top to bottom below there. The first one's called the McClellan oscillator. And this is a way of analyzing advanced decline data, right? On an average day, you have the advancers, decliners, how many stocks are up, how many stocks are down. Tom McClellan's parents, Sherman and Marion McClellan, decades ago, came up with this oscillator, kind of turning it into a momentum indicator, measuring the changes in breadth conditions. If it's above zero, it's bullish. If it's below zero, it's bearish. And that is a very simple way of thinking of that measure of breadth. The next panel down is looking at, what am I looking at there? Oh, percent of stocks above their 50-day moving average. So this is, while the S&P is above its 50-day moving average, and I think that's an encouraging sign, you look at all 500 stocks in the S&P, how many of them can stay the same? And when that gets above 70%, we're in a kind of a euphoric level. When we come out of that 70% level, it can tell you that things are maybe starting to change. And then in the bottom, in the green and red histogram there, That's showing you every day the new 52-week highs and the new 52-week lows. So it's literally counting how many stocks are breaking out, how many stocks are breaking down on any given day. So if you look at the performance going into that purple shaded area, which again ended up being the 2000 market top, what were the breadth conditions going into there? We had the McClellan oscillator above zero, and it remained above zero for quite some time, right? 4 or 5 weeks, just showing you that the short-term breadth was very strong. The advanced decline data was improving. We had all of a sudden over 70% of the S&P 500 members above their 50-day moving average, which means kind of almost everything is in a primary uptrend at that point. And you have a bunch of new 52-week highs, meaning those leading names are kind of getting it done. And you have very few stocks making new 52-week lows. Look at how that changed as we get toward the end of that purple shaded area for the S&P 500. You can see everything I just said was no longer the case. So the McClellan oscillator breaks below zero, which tells you the short-term breadth is starting to change to more bearish advance or decline data. Stocks are trading lower on an average day. Instead of over 70% of stocks above their 50-day, we have less. We have 60, we have 50, we have even 40. So a lot of individual names are breaking well below their 50-day moving average, even though the S&P is still above it. Then finally, we have less and less stocks making new 52-week highs. So the green histogram is sloping downwards. So that suggests that those leading names that have been driving the S&P up, there are less and less that can say that, right? There are less and less that are going higher. So without looking at a bunch of, hundreds of individual charts of stocks, you can see from the breadth data that the breadth conditions were slowing down, that stocks were breaking their 50-day or their 10-week moving average, and that the new 52-week highs were becoming less and less. And you can see what happened in the months after that is everything just started to get worse and worse. You had a bunch of stocks making new 52-week lows. And so recognizing when the market is making a peak, I immediately glance down on a chart like this and just see, is the breadth data supporting it? And then when am I seeing the breadth data no longer supporting that uptrend? And often that can be a major top. And that's how 2007 actually, the reasons for it came clear later. But I think the technical reasons using market breadth were pretty clear, actually.
Yeah. Well, you know what? It's interesting that you mentioned that because I remember that time period. It was such a, I'll be honest, 2007 was not a great year for me. It was a lot of slop until August, and
Yeah.
September and October were phenomenal. Like all the money was made there. And you know what? If it's okay, I'm going to change charts real quick. I did a change date to that time period, and it's interesting because a lot of those areas that you mentioned, where it started to break down, it was right in the middle of October, where you started getting the McClellan oscillator. And I remember this day right here on October 11th, 2007, a big downside reversal. It was like, oh, okay, this might be the warning sign. And I'll be honest, what happened to me though is, we kind of went sideways for a little bit, and then I remember this vividly, Halloween, it was, oh, we're breaking out into new highs. We had gotten all this distribution. We broke out to new highs, and it was like, oh, maybe this is okay. And it was kind of like, I got to get back in. And then, exactly as you mentioned, it was, things really started breaking down in a big way, very quickly. I mean, I remember this day, November. Yeah, I thought it was November 4th, but yeah, maybe it was the 8th or something. I mean, I had VMware and, the IPO VMware, and, I think Crocs, was one of the big winners at that time. It had this, horrible earnings reaction on the 1st of November. And it was just November. There was just nothing good could happen. It was, everything was breaking down. So really interesting that, again, those breadth indicators kind of got you in that environment. And the S&P 500 was not as ugly looking as the NASDAQ, but it certainly it certainly had some issues, and very quickly.
And it's worth noting there, by the way, that end of October on Halloween, the NASDAQ was making a new high, but the S&P actually was not. That was actually a really interesting non-confirmation, which with one of the benchmarks breaking out, the other one actually made a lower. The S&P made a lower peak at the end of October. Yeah.
Right. Yeah. So a really good example here. So let's go ahead and go back to your charts
Yeah.
real quick, and you've got another example to kind of show us. So
Yeah, so yeah, the next one that comes to mind would be the 2020 peak, and before you go, telling your friends Dave is claiming he predicted COVID with charts. That's not what I'm claiming here. But what I am claiming is that what ended up being the peak, the deterioration had already started to happen. And
yeah.
again, what the lesson here is the breadth divergence, right? The breadth indicators breaking down often happens as we're making a new high, which is why it's so counterintuitive. So if you're
Mhm.
not paying attention to sort of the metrics underneath the market, you see the S&P or the Nasdaq making a new all-time high, you think this is awesome, new highs are good. One of my mentors, Greg Morris, used to tell me all new highs are bullish except the last one. And so I think using tools like this to recognize, okay, new high, that's great. I immediately glance down and say, all right, are more and more stocks really participating? And what happened at the 2020 market peak? And again, a lot happened after the shaded area where COVID became a reality, and we all
Right.
sort of struggled with it. But the breadth conditions had really started to deteriorate, right? So again, the McClellan oscillator breaks below zero, telling you the short-term breadth is getting weaker. You can see all of those breadth indicators are trending lower while the S&P is making a new high into the February peak, and particularly the new 52-week high. So even though the S&P made a new high in February, less stocks were making new 52-week highs during that period. So again, there's a cohort of leading names doing quite well. The next new high, less stocks are participating. And that divergence, not to jump to the punchline of what we're seeing now, that's one of the things that concerns me now in
Mhm.
October of 2024, is you're seeing that same trend where there are less and less new 52-week highs as we're starting to make new highs now, particularly in the last couple of weeks, kind of from mid-September now to early October. You're seeing the S&P break out. You're seeing the McClellan oscillator break below zero. We're seeing the percent of stocks above the 50-day. It's literally right at that level as we're doing the podcast here.
Mhm.
Yesterday was below, today slightly above it. It's right at that 70% threshold. And the stocks making new 52-week highs have been trending lower. So again, on this week as we're breaking out, less stocks are participating. So the breadth divergence is what concerns me in a market like we're seeing now. And again, what this little history lesson tells you is that's what a lot of market peaks have kind of looked like, that divergence. The saving grace, I would argue, is something we saw back in like January, February of this year, where breadth conditions were a little negative, but the Magnificent Seven stocks were so strong that despite the weaker breadth, the benchmarks were able to remain quite strong. And that is a brutal environment for stock pickers. It's a brutal environment for active money managers who are trying
Mhm.
to pick stocks outside of the Magnificent Seven. Because
Right.
if those are what's working and other things are not participating, it's really hard to outperform unless you just layer into those mega cap names. And I think that's the risk for the market here, is a lot of stocks maybe start to not work, but the benchmarks remain strong enough that it's a really tough environment to outperform. That's a risk here for sure.
Yeah. And I mean, that's where a lot of the closet indexers come from. I mean, they're almost being, why stick your neck out? No one's going to fire you for buying Microsoft or Apple, or, one of those things where it's kind of the safe bet versus, going out a limb, not having enough,
Yeah.
again, especially compared to the indexes. Well, and to that point, you mentioned how a lot of times in the past, this breadth indicator was kind of reflective of the fact that maybe some of the defensive names, the big defensive names, were what were kind of propping things up. But now, I mean, are Microsoft, Google, and Apple the defensive names now? I mean, it certainly seemed like it for a while there,
Yeah.
because especially as rates were going up so much, it was kind of like, well, these guys are sitting on all sorts of cash. Higher rates don't affect them because they don't need to borrow.
Yeah.
They're just in a position of strength. But is the Magnificent Seven defense now?
It's interesting because the Magnificent Seven names, not all of them. I mean, I'm ignoring Tesla when I say this group now. So this
Mhm.
group of mega cap leadership names show a
The
lot of
Trillion
the
Dollar
characteristics.
Club.
Yes, right. They show a lot of the characteristics of mature companies, but a lot of the characteristics of growth, right? And when AI is one of your big growth engines, I mean, you're certainly more of a growthy name at this point. But again, I mean, these are more established companies that are sort of immune to market dislocation. I'm still going to use my iPhone, and I'm probably going to still buy another one when it's time, regardless of what's kind of happening overall. Whereas Some of the more speculative emerging growth names probably have a little tougher go with things. So I think they're a little bit of both. And if you ask, right, if you're concerned about the market going down here, where do you go? I traditionally would say defensive sectors, right? Utilities, which have been pretty decent recently, and tend to be good low volatility ways of making it through. But I mean, Meta, Apple, Nvidia. I mean, these are pretty stable companies that certainly are tied into emerging themes. The other thing to think about is more of as a long-term, as a long-term investor, and really thinking about what themes are emerging that are probably going to be successful years later, right? What things do we see ourselves? What products and stuff do we see ourselves using down the road quite a bit? Electric vehicles and the growth in that area of the market. I think undeniably the reality that we'll be experiencing AI and related technologies, blockchain technologies. I mean, I think over time those will be quite well. So those big, stable tech and communications names that will benefit from those themes working seem like a safe place to be.
Well, and interesting enough, a lot of times we've been talking about, you mentioned the utilities, and this is again what you typically think of as the boring. Okay, this is what you give the widows and the orphans, so they can get their dividend and everything like that. But it kind of almost turned into this AI adjacent. I mean, one of the stocks I ended up selling today, because Constellation Energy, came in quite hard, but this beat Nvidia. I mean, I think it was the top. Between this and VST, Vistra, I think these were, the top, stocks in the S&P 500. They're utilities. What, like how do you have a utility topping the? I mean, usually if that happens, it's because the S&P 500 has gone down and the utility didn't go down as much. You don't typically get a utility being top of the S&P 500 when it's going to new highs. So again, is there something different going on? And again, people always love to say it's different this time, but is there something different going on?
I mean, and you're right. I think the traditional idea is thinking of utilities as sort of that low volatility defensive play, because if the markets are going to go down, I mean, the reality of active managers, money managers, is you tend to do much better in bear markets because you can get in defensive things that will not go down as much. And that's where you really earn your keep. You cushion from a lot of downside. Utilities, in a lot of ways, if you covered up the ticker of CEG or something and asked someone to guess what it is, I guarantee they would not say a utility stock. They'd say technology or like a biotech or, some more growth area of the market. I read something, and I forget who, I can't credit where I saw this, but it was looking at the utility company earnings calls, sort of the multi-utilities in like Q1 to Q2 to Q3, kind of going through the month, and the number of times crypto and the energy requirements of crypto mining, and it was like mentioned 0 times the first quarter, and then almost all of them, it was mentioned the second time. So that is certainly, I think, part of this is the energy requirements of crypto mining and other related technologies.
Well, and AI too.
And AI as well, right? I mean, they all require a staggering amount of computing power. That all requires a lot of energy. And so all of a sudden, utilities are a growth trade. What I love about it, and what I love about what's happened with utilities, the charts told you that these are good places to be, right? And I always tell people the reasons why something works are crystal clear in the rearview mirror. So you don't have to know why CEG is necessarily a great call. The chart tells you this is a good place to be, and it tells you it's outperforming. And so if you thought the markets were going to go up, so I definitely don't want to own gold and utilities in 2024, talk about the wrong call, right? Because those are some of the strongest places. So for me, the lesson learned is focus less on what you think should happen, although that's an important thought process to go through. But don't forget the benefits of recognizing that the trends will tell you something that you'll learn the reality of much later, right? It'll make sense down the road when they write a book about 2024, but don't miss an emerging trend just because it doesn't make sense to you at that particular time.
Yeah, that's so important. I mean, I feel like there have been so many cases where, I kind of joke. There was the show Early Edition. I don't know if you remember that, where the guy gets, he gets the paper,
before
and
it happens.
Before, a day ahead of time, and there's a cat involved, and we never know what the cat's issue is, why the cat's there. But he gets the paper, and he does good with it. He's trying to, save people and everything like that. But I kind of think, you would think that with that information, it would be invaluable. But I
Mm,
sometimes say, well, gosh, man, if you had given me the headline, I would have done the exact wrong thing. I mean,
y-
COVID,
yeah,
when COVID
yeah,
was happening, to your point, everything looked like it was falling apart. But yet in April, we kind of had a follow through day. And yes, in the rear view mirror, it's like, oh, well, obviously the stimulus and, everything that the Fed was doing and, how much they increased their balance sheet. Yeah,
yeah.
obviously, when you have that much money sloshing around. But at the time, if you just looked at the headlines, no one was talking about, oh, look at what's going to happen a year from now in the market because of, what the Fed is doing. It was, oh my gosh, the sky is falling. So yeah, very
Yeah,
good point.
in my institutional days, we would call that you got the market call right, but you didn't get paid for it. And
Mhm.
it was like your gravestone as an analyst would be, got the call right. And it's like what does that really get you, right? Because you're paid to outperform. You're paid to own things that are doing better than other things. And so
Yeah,
getting the call right, getting the idea, recognizing a theme that's emerging like that feels good,
yeah.
but you get paid by owning things that benefit from that. And a lot of times that can be very difficult to gauge at the beginning. But again, I think recognizing when the charts start to evolve, that tells you something's happening. And
Mhm.
as we go on, we'll realize what that story is and we'll make sense of it. But don't miss an opportunity just because you can't get your head around exactly what's going to create the value. And again, I think what's great about price action is it usually tells you what's working, and because it's always right. The market's not wrong because the price is reflective of where things are headed. So
Mhm.
when in doubt, follow the trends.
Mhm. So to kind of just wrap a little bow on this, because
Mm,
I want to make sure we are a little bit clear for our listeners, because when you're showing those breadth indicators, it's almost like, uh-oh, watch out. Especially, frankly, I mean, you showed 2007 and 2020,
yeah.
which were both some
And,
really
and to be
horrible.
clear, I think the header on that last one should be 2024 market top question mark, right? The
Okay.
question mark maybe should be there.
Yeah.
Well,
Yeah.
to be
So
determined, right?
right, to be determined, because again, in our first segment we were talking about how great everything looks and the trend is up, and
Yeah,
this kind of goes against that. So
yeah,
what what is it that tells you that, oh, maybe this Brett thing was telling you something important that you need to watch? Or
yeah.
is
So
it like, oh,
yeah,
this time it's more like January, where breadth didn't matter, it was the indexes kept going up?
yeah. No, that's a really thoughtful question, Justin. I think that's the reality, right? With the 2007 top of the 2020 top, what happened after those breadth conditions changing is really the most important part, which is you then started to see the price trend finally move in line with what the expectations would be,
Mhm.
right? And then, as I mentioned, a lot of these breadth divergences, when breadth starts to rotate lower, even as the indexes are going higher, that's a leading indicator. For me, I want to look for confirmation or what I would consider follow through, right? So after the peak, you start to see the price break down through those lines in the sand. We mentioned like with the S&P now, 5650 is a line in the hand,
Right.
maybe line in the sand, maybe the 50-day moving average or whatever it is. So as long as we hold that, and producer Mike, well done. That was awesome. With delivering with the question mark. Thank you for that. Just to save myself here. So I think still to be determined, but I think what this tells me is okay, there's now an elevated risk of deterioration in price because these conditions look very similar to previous market tops. Now the proof is going to be in price reacting in a negative way. So starting to be unable to hold support, pulling back, and instead of making a higher low, you see further deterioration. The breadth conditions continue to deteriorate. We see less and less new 52-week highs, but you start to see more 52-week lows, which
Mhm.
those other two peaks, all of a sudden you set a bunch of like leading names to the downside that had already deteriorated quite a bit. We're not seeing any of that yet here in October. But I think that's what you look for now is you look for confirmation that, yep, the breadth conditions really were a good identifier of negative conditions. The price is now reflecting what I was concerned about.